You may have seen this in the headlines back in August 2025. US President Donald Trump signed an executive order that could change retirement investing in the US. It directs regulators to allow Americans to put money into private equities and cryptos through their retirement accounts. Sounds like a big deal, right? Well, here's the thing. Canadians have been able to do this for years through their RRSPs. So, what exactly is private equity? Equity is often referring to a share in a public company, also known as stocks. Private equity, at its core, means investing in companies that are not publicly traded on the stock market. These are long-term, illiquid investments in private company shares. You can't just buy and sell them with a click. And because they are private, financial statements and information are not available to the general public. That's why some people joke that private equity is where insider trading takes place. Now, don't get me wrong, that doesn't mean it's illegal. It just means that insiders, like the executives and the investors in the fund, have access to information regular investors never see. That inside edge is part of how private equity works. You might wonder, who can invest in private equity? Traditionally, private equity was a very closed club, big players only, pension funds, university endowments, or ultra-wealthy individuals who qualified as accredited investors. We are talking about millions just to get in. But today, access is opening up. Firms like Carlyle or Blackstone are now teaming up with Canadian banks to create retail-friendly private equity funds. The minimums have come down. Usually it's $25,000 to $50,000 instead of millions. But keep in mind, the fees are higher than your average public market fund. People often confuse private equity with venture capitals. They're cousins, but not twins. Private equity usually buys into mature businesses, companies that are already profitable, but may need some improvement. These investors often take controlling stakes. Venture capital, on the other hand, focuses on startups, unproven, risky, but with explosive growth potential. Think of it this way. Private equity sharpens businesses that already makes money. Venture capital bets on the next big idea. So, why would anyone want to add private equity to their portfolio? Well, the upsides are attractive. You get access to companies before they ever go public, and you diversify beyond stocks and bonds. And historically, you can see higher long-term returns. But it's not all upside. There are some real drawbacks. The fees are high, your money is locked up for years, it's not liquid most of the time. And of course, there is exit risk. You might invest in a company that never goes public or struggles to sell. Now, why it matters today. Think of companies like Stripe or SpaceX. They were worth billions long before going public. By the time everyday investors got a chance, much of the growth had already been captured by private equity and venture capital investors. That's why private equity is exciting. It lets you participate earlier in the story. But again, it comes with higher risk and less liquidity. So, here's the takeaway. Private equity can be a powerful addition to your portfolio. It gives you diversification, potential growth, and exposure to companies most people never touch. But it's not a silver bullet. It's expensive, it's illiquid, and it requires patience. That's why the smartest approach is moderation. For most people, private equity should supplement your traditional stocks and bonds, but not replace them. Used wisely, it can smooth out volatility and give you access to growth others can't. If you are watching this, you're already asking the right questions. And that's exactly how smart investors think. If you want to learn how to build a portfolio that balances traditional markets with alternatives like private equity, send me an email or grab my book, Canadians, Do You Have a Financial Plan? It's on Amazon. Let's make sure your money works harder than you do. See you next time.